Hello, I'm Joshua from Shockley Bookkeeping, and today I'm going to talk a little bit about a topic that's very misunderstood in tax and can lead to a lot of people getting blindsided come tax filing time in April. And that is the concept of understanding how your type of income pays tax. Today will just be a high-level overview. Before we start, a quick caveat. Some of the tips we discuss today will be general rules of thumb that we give to clients that may or may not apply to your specific situation. To find out more about your specific scenario and how to best plan, you'll probably want to sit down with a tax professional for individualized guidance, but more on that later. So we're going to start out with the most well-known type of income, and that's W-2 income, where you work for an employer and they pay part of your tax liability throughout the year. Probably received at some point in your life a W-2 at year end, and this is really it's the least stressful type of income overall. It's the most set it and forget it type of income to tax. It's also the government's favorite type of income because honestly it's harder to create fraud through W-2 income. There's a higher chance of collectability on their end because your federal income tax is being paid to them with each paycheck throughout the year, and also because W-2 income is also one of the highest taxed incomes by percentage in this list that we discussed. A big reason for that is that you just don't get to take any deductions at all. There's no mileage, there's no home office deductions, nothing. An employer can reimburse you for certain expenses, but you can't take deduction. For a single person with making a normal living, we usually recommend about 10% in federal withholdings. And most people ask, how would I check on that? Well, you want to look at your last pay stub, and it should have a year-to-date column, and you'll want to look at the gross income year-to-date before taxes, and then find your federal withholdings year-to-date and look at that number. That is about 10% of your gross income. You're probably in decent shape. Now, the question we sometimes get asked is, what if I withhold too much? 12%, 15%, way more than I needed to. The good news is that it's still your money. You won't lose it, and as long as you file your tax returns. Paying in too much is usually the reason you'll see a refund in April, so there's really nothing to worry about there. Now, for more complicated W-2 earnings where you have a family, kids, and a spouse maybe working their own job, you really want to sit down with the preparer, especially if you've been noticing that you've ended up owing these past couple of years. If that is the case, you're probably getting hit by that dreaded two-job syndrome, which can happen even if you have the correct amount of dependents claimed on your W-4 when you sat down with your job's HR department initially. And this happens really because the payroll department of the job you are filing paperwork out for assumes that this job is the only job in your household and it withholds federal income tax accordingly. But if a spouse is working, they may be pushing a lot of your household's extra income into a higher tax bracket, and your current job is not taking into account. You'll probably have to adjust the extra withholdings on your W-4 to adjust for a spouse's income. A good hint is if you're owing each year and don't know why, there's a good chance someone's job is not withholding the proper amount. And again, like I said, it might be time to sit down with a tax professional to look at the situation. Here at Shockley's, we do offer a free first-time 30-minute consultation where we can do some tax research by looking at your prior returns and your most current pay stubs and see if you could benefit from some small adjustments and also answer any other questions you might have. For that, we will be signing off until next time. Y'all take care. Bye-bye.